Update. My name is Mark Alara and I'm joined by Kenneth Beanland, both directors at Vincent's, and also Kenneth is our senior portfolio manager in our Morgan's North Key office, so hence the relationship with the following slides. It's been interesting times at the moment. There's never a dull moment in the markets, and with COVID lockdowns, reporting season, Evergrande, hopefully today we'll be able to probably reflect on some of those issues and provide some thoughts on some of the key issues and where to from here. So for that, I've got Kenneth.
Welcome. Thanks very much. Good to be here.
All right, so we might jump into it. All right, first off is the reporting season, Kenneth.
Yeah, it was a really pleasing reporting season, and I think you've got to think back to 6 months ago, and what we were seeing was one of the best earnings reporting seasons coming out of February, but it was off such a low base. There was a lot of uncertainty around in the markets at that stage. Moving through to this reporting season, it was really more of a normalised period. We had really strong earnings revision right the way through, so over 6 months of earnings revisions, month on month, positive into reporting season, and what we saw was really pleasing. We saw the large end of town, so the top 50, have more beats than misses, and by that I mean it's not so much how a company reports, but it's how a company reports against consensus, and the top end of town, we saw some really great signs, and we'll touch on those on another couple of slides. But when you're seeing dividends being paid and you're seeing capital management, which is being directed by the boards by some of the largest institutions on our market, it's actually a really positive sign that those companies are in great shape. But what happened through reporting season in the mid and small cap area was fantastic. The industrials really strong, one of the best consensus beats over that period that we saw, and then we flow that through to an overall market valuation. And there's always questions being thrown at us around, is the market overvalued? We've had such a really strong run up, and we point to a couple of different ways to value the market. The first, you just look at the forward multiple of the market against where it historically trades at. Now we're in surprisingly to some, but we're actually in a really strong period of earnings growth, and you would couple that with an elevated price to earnings multiple. That's what's happened, but really it's inside what we would say is a reasonable expectation over a 10-year average period. So the bottom right shows that, and while we are elevated, given the situation, and the other side of this is bond yields where they sit, we would argue that it's not excessively overvalued. The other way to value, and one in which we'd look at, is a comparable between an earnings yield. So an earnings yield is just the inverse of a price to earnings multiple. And then what you do is you look at where bond yields sit, and then you get the equity risk premium that the market trades on. And so that top right-hand graph or table shows you where Australia sits, and then we've just taken a couple of different sectors and areas of the market where you can look at it and go, well, really, against the 5-year average, we're basically in line on an earnings risk premium. Whereas if you look at the US or the UK or China, the Eurozone, they're very expensive. So relative value, there's China, Japan's in there, but relative on a valuation basis, we would argue it's not as stretched as some people might think. So taking a look a little bit beneath the surface, and this is just to give you a little bit of an overview of how different sectors performed over the previous year. And then what we've done is taken that 1 month return period. And just, the differences between the two have actually been quite stark. So over a 1 month return, we've seen some pretty strong, as an aggregate anyway, a pretty strong total return period for energy. And we'll touch on that later as we move through into the resources space. But the one that I do want to pick on here is healthcare. It really doesn't look like over the past either 1 month or 1 year that it's had a very good, period of return. Now, and that's correct, but we tend to focus on healthcare as that core defensive with almost a sustained long-term above average growth rate than the market. And so when you take that out and you look over 5, 10, 20 years, it's been one of the best performing indexes that we follow on the Australian market. Just quickly, you can see that technology, and it makes sense, over that 1 year has just been tremendous. You can follow that through over to COVID as well. So you think about the requirements that businesses and households have needed over this really uncertain time period to access their critical infrastructure to be able to do business.
That's probably one of the sectors that we'll be monitoring going forward, that tech space, particularly if we get some rising bond yields, just on the way that they price those valuations.
I completely agree. When you see news in the press and if inflation starts to really increase, and you see those bond yields start to tick up, as we saw last night, what you tend to see is those ultra high growth sectors of the market, so things that trade on revenue multiples, really, really excessive price to earnings multiples, they come under pressure because of the discount rate that you use in cash flow, discounted cash flow analysis, increases. So it makes numbers far out look less attractive. And all things being equal, companies that are paying solid dividends and solid earnings in the short term, it doesn't have as much impact.
So the focus will be on those kind of companies that are actually cash flow, delivering sustainable, consistent cash flows now, as opposed to forward earnings of cash flows with rising bond yields.
Agreed.
Yep.
Now, just a final piece on reporting season. We thought there's actually 3 major themes. The third is around mergers and acquisitions, and highly topical at the moment. But we'll touch on that in the domestic economy section. 2, I thought, pivotal pieces of information that came out of reporting season was around dividend growth and capital management. So this period through August and September has been the best dividend season on record. You can see week by week on the relative dividend payouts on the right-hand side. It was an absolutely exceptional time for income-focused investors, really led by the big miners. So you think BHP, Rio, and Fortescue. But importantly, it's not to take away from how strong that was in that mid-cap industrial space. We had the banks coming back as well. We had 18 months there where periods of what we would call really strong cash flow generating businesses that people rely on for income, they had big reductions. So you can think about a Sydney airports, Auckland airports, but the banks as well. And what I think is really pleasing is if you want to see a bellwether for the Australian economy, you look at our big 4 banks.
Yeah, I think that's probably one of the key things. But the expectations of the BHP and Rios, making fistfuls of cash, in this recent period, and you'd expect that to come through. They're cyclical, so that's nature. But you're right. I agree with you on as a bellwether. It was nice to see the banks, and the sign that we can take from that of their comfort in our economy at the moment.
Yeah, and you follow that through to capital management. Yep. So I think one of the other big themes is how strong balance sheets were, and that's from companies resetting their cost base through COVID. Exceptionally uncertain. People were very focused on cash flow. Now people have or companies and in particular boards, they have to approve this. They've felt that they have enough leeway in their retained earnings and their forward guidance that they've been able to do off-market buybacks. We've got CBA at the moment. Woolworths was another. Link. It's been a really strong tick of approval for the Australian economy by the boards and the larger end of town through reporting season. So I think when you put all those together, even in the situation we find ourselves in now, which is we've got 60% of the economy in lockdown, I think you can see that light at the end of the tunnel.
All right, economic and interest rate outlook. Certainly one that's getting a lot of press at the moment. Some of these, the spaces in here is I would, to me particularly, I think employment numbers or unemployment numbers is quite surprising given COVID and lockdown, and we're seeing a lot of questions around interest rates and inflation. So, as a topical topic. This is certainly something that be good some clarity around it.
I think if you had told me last month with Victoria and New South Wales in full lockdown,
big contributor to our economy,
that and not much movement between states either, that the unemployment rate actually dropped. It went from 4.6 to 4.5%. That, in my opinion, is absolutely incredible. So then you take a step back and go, well, maybe the participation rate fell off a cliff. It didn't. It fell. It did fall, but this is still at historically high levels. And we just point to that towards, well, yes, there might be some, underemployment or people that aren't getting the same amount of hours, but businesses are hanging on to their workers because, in our opinion, they know that in the next 3 to 6 months that you're not getting those international visas coming in, that you're going to require your workers for the reopening of the economy, and that may cause some wage price pressures that we haven't seen. So and I think that's a big part of what's happening at the moment in Australia and indeed globally.
Yeah. So from a positive aspect, the productivity. We're well positioned for that on reopening. The place to watch here is the wage growth and see how that, because of the potential tightening of supply of labour, that see how that flows through and whether actually we see that wage growth and do we see that flow through to inflation? To
inflation and then interest rate expectations. If you think about 4.5%, that's the best we have seen in over a decade in unemployment. And I don't think anyone could have envisioned that even 6 months ago. But I think it flows on nicely to interest rates. And so we'd like to take different research houses' opinions and really canvass the market. And I think the consensus position is around central banks. So if you think RBA, Federal Reserve, at present, they're going to keep a sustained amount of liquidity in the markets. What's going to move that? Now, we think that when you're looking out probably over the next 3 months, not much. But if you start to see a sustained spike in inflation caused by wage pressures, that's going to be the trigger to see those interest rates tick up. It doesn't have to tick up much though. If you look at that domestic fixed interest market activity, you've got a flat yield curve beneath 0.2% out to really that 5-year mark and 3-year mark. It looks like a really big jump towards that 10-year, but if you follow that through to the left-hand side, it's 1.4%. it is still an exceptionally low interest rate environment we find ourselves in, and you can see how people are pricing it. So institutions are pricing it by that 10-year government bond yield, because the RBA is only suppressing that 1 3 to 5 year yield curve.
I think one of the key things you mentioned there was, when we're looking at indicators here, is when we're talking about inflation, you use the word sustained inflation. I think that's the key, because we are expecting, parts of inflation, but
you're seeing above trend inflation at the moment.
Yep.
And you're seeing that through the supply shocks that we've got in the economy.
Correct. Yep.
And that's flowing through to how much people are paying for some of these goods. On top of that, the deflation that you've seen in travel, that might moderate out as well. So it's a really uncertain time period. I think it is bipolar in the markets, whether people are thinking it's going to be sustained or not. It's a really difficult question, because you're right, at the moment sustained inflation is the question, but we do have this short-term impact, particularly around the supply shocks.
Yep. So we're likely to see, the likes of the Reserve Bank, whilst their mandate is to manage that inflation between 2 and 3%, is that they'll be supportive of employment through this period.
That's
for an economic
Governor
recovery.
Lowe has specifically come out and stated that, and it was only a couple of weeks ago where he's actually come out and said we are not moving rates anytime soon. So it's a watch this space. I suppose the final area of what we want to look at in the domestic economy for this webinar is around business. And I know I touched on it earlier, but one of the other key themes to come out of reporting season has been mergers and acquisitions. Huge amounts of money are looking for a home, and they're looking for a home for sustainable long-term cash flows. You can look at where the super funds are looking to acquire. So Sydney Airports, AusNet, Spark Infrastructure. It's been an absolute bonanza. And just to put this into perspective, it's the most amount of mergers and acquisitions that we've ever seen in dollar value on our market, and we've still got 3 months to go. It's pretty incredible. And I think it flows through to what we've been reading in around the companies on their market and their capex intentions, going out and looking for those new opportunities to expand, because if you've got cash in the bank, or you've got a debt funding facility where you're getting 2%, it makes those return hurdles a lot more I want to say acceptable,
easier to achieve.
Thank you very much. So I think the one thing to come out of this is, just recently we have put this in around the domestic economy, is property. It's been absolutely on a tear. It's fantastic. It gives people, consumers confidence, the wealth effect that it creates for people. The alarm bells are starting to sound, because when you start to get at debt to income levels at really, really elevated marks, what can happen is, if this sustained inflation comes through, then those debt burdens are going to really affect those people that have over leveraged. And it doesn't take much when you've got an interest rate now at say 2%. That goes to 3%. That's a huge increase compared to if we're at normal times and it went from 5 to 6%. So it's something that the Reserve Bank's flagged in today's press. Frydenberg was in the press talking about the same thing. Now, whether it comes in or not, we're not sure, but it is a relevant issue at this point.
Next, we've got the US economy. I suppose one of the things we might see take the headlines over the coming weeks, maybe around that US debt ceiling, whether the Republicans refuse to help the Democrats raise it. It seems that it's their turn now to go in opposition against Biden's spending plans.
Screws.
Yep. So we might see some volatility in the short term, but really what we're focusing on is more about the fundamentals here at the moment?
Yeah, well, we'd sort of look at the US and they're probably about six months ahead of us. They haven't had these sharp, harsh lockdowns for an extended period of time over the last 3 to 6 months. And what we've seen is some of the best growth numbers really from that the terrible March, June of last year flow through, and now that is starting to moderate, but it's still at a very high level, which is really good to see. And I think what the other focus level, and I showed a graph last time that showed the unemployment rate from 1970 through to 2021 at that stage, and the unemployment spike that happened in the US looked like a data aberration. It just had no one had seen anything like that before. What's really pleasing is you can see it down the bottom right, that is starting to moderate and continuing to go down. That's a key marker for any central bank. Now, when we look at the US, we still think that there's going to be very, very strong and accommodative fiscal policy. They've got infrastructure spends still going on. There hasn't been any reduction in central bank policy yet, although they are starting to adjust their inflation expectations higher. It's running at a decade high, close enough to over these past few months. Now, whether that flows through, again, it's the same question that everyone's asking themselves across the world, and I think the interesting thing is to watch the interest rate expectations of these central banks, because we have seen a slight increase. Whether that turns into we need to act now and really turn the taps off, I think that's going to be the catalyst for some volatility within all sorts of asset pricing.
Yeah, I think we're starting to see some of the terminology they use in their announcements adjust slightly. So, in preparation. All right, commodities and energy, very topical. We've got China and energy at the moment is we're seeing some spikes there.
So going back through to that dividend bonanza that we saw, the three companies that really stood out were BHP, Rio, and Fortescue. We were back. It was only a month ago, or maybe a little bit longer now, that we had iron ore at over $200 US a ton. That was the absolute peak. What we look at is consensus data to see where expectations were for that price. No one was anywhere near that. You look through any sort of analyst recommendation or expectations for the iron ore price, and it sits around that 60 to 70 long-term average a ton.
They're the numbers that are factored into the modelling.
That's right.
And I think that's important to note. So when we see those valuations, they're looking at those spot prices as opposed to the current valuations.
And that's completely correct. What you've seen though with some of this, and if we take iron ore out, because that has been such a rapid decline, is that there has been some weakness through other commodities. Energy's bounced a little bit over the past 5 days, but if you look over the last month or two, the general weakness through the copper and the base metal. Now, that it's no coincidence in our view that you can tie that through to a slowdown in the Chinese economy. They themselves have had some issues around COVID. You then have to look at, well, what's coming up, and when you've got the Chinese Communist Party looking through to that Winter Olympics, they don't want to have the pollution that everyone's accustomed to. I think that there's a bit of a political issue there. So what they've done is they've curbed steel output. Now, we had an 8% increase in steel output through the first half of the year. They then came out, the Chinese government then came out and said that they don't want to have any increase between 2020 and 2021 in steel output. So that just means that there's going to be a negative or a contraction within that steel within the steel markets in China. That has put pressure on that iron ore price as well. We sort of take the view that the short-term weakness that we're seeing, and this may persist for the next 3 to 6 months, is a temporary issue, because you've got such strong global growth at present. You've got big infrastructure spends flowing through to not just China, but indeed Australia, the US, Europe. And then we'll just take copper for a quick minute and go, well, this period that we've got is a huge step change in energy, the way people demand energy. We're moving to the electrification of the world, and the amount of copper that's required to do this change is absolutely huge. So we think there's the right mix of variables that over the next 1 to 2 years that's going to be very, very supportive for resources. Just on, I know I just touched on copper, but when we look through coal and energy, you can see that people dislike coal, but it doesn't correlate to the price on what it's trading at now. Metallurgical coal has just been absolutely amazing, and you look through the lack of capital that has been invested in some of these commodities because of a range of reasons, and what that does to when the demand side really kicks into gear, because you don't have that huge supply anymore, and so we're at all-time highs for met coal, decade highs for thermal coal. We're of the expectation that thermal remains elevated. It will come off, but it will remain elevated over a couple of years. We think met coal's probably at its zenith, which did we expect it to get to where it is? Probably not either. So the other area is we're seeing it now, LNG and oil prices. Some of the gas prices over in the UK at the moment, and indeed Europe, are really, really strong. We think that's going to flow through into the sector in Australia, but the bottom right hand side actually shows the disconnect between the oil price, and that's very closely related to the LNG price, and how the energy market's gone. So there has to be a reckoning one way or the other. And we're of the view that it's to the upside for the energy sector.
All right, Evergrande. Now this is we've seen plenty of press around this in particularly last week or so. I suppose just to clarify, why we're focused on this is, as second biggest property company in the US,
China.
US in China. It's got 300 billion in debts approximately, and that you've seen the Chinese effort to reform some of their debt-ridden behemoths in the Chinese economy. So the question here is what we're looking at here is whether how this will unravel, and it's more around the contagion effect and whether it flows through to other areas of the Chinese economy, and whether the Chinese government will step in and how this will flow. And I suppose for us, as one of our biggest trading partners, it's obviously important to us in something that we monitor.
Yeah, I completely agree, and it's very topical at the moment. We're lucky enough to get briefed by institutional fixed interest managers, and this is where currently where the apex of the issue lies, because you've got a huge property developer that hasn't paid its debt coupons. It hasn't officially gone into default yet, and what that's going to do towards not just itself and the bondholders, but you're right, through that broader sector in China. Now our view is consistent with theirs in the fact that there is very, I don't want to say little chance, but we're of the view that it's going to be a restructure will happen, and that if things got really bad, if the property market in China started to decline materially, that the government would step in, that they would provide the stimulus, because their major mandate over there is for social stability.
Yeah, they want to protect the end consumers here.
That's right.
Yeah.
Now, whether it spills through, we have seen significant weakness in the property sector on an equity front, but we haven't seen a really big contagion through the bond market for the other property developers in China. The correlation has started to drop between Evergrande and the others. Initially there's a big sell-off, but that started to tighten up again. Now, the one area that I think is of concern though is what that does to our commodity market. Whether that whether the issues that Evergrande face and does that flow through to a significant slowdown and sustained slowdown in the property sector in China, because that is a huge consumer of steel, which will flow through to the iron ore producers.
And there's still, I was reading, there's still such a massive, development sold off the plan yet to be developed as well to go through the pipeline.
Well, we had a respected fund manager in this morning, and their comment around the Chinese property sector was that people are buying the property, and so these are units,
apartment blocks.
Not houses, and they don't even rent it. Their expectation is that the capital appreciation will just continue. Now, just quickly to touch on, will this be another Lehman Brothers? Our expectation is no. We just can't see that happening.
All right, now to our models.
Yeah, so just quickly, we run a few models here at the North Quay office. We have an income-focused, a growth-focused, a balance, so a mixture between the two, and an ethical model. Now, all of them have been, three have been running for over a decade now, and then the ethical model has really only been going for a year, but we've seen some pretty pleasing returns. All are looking for different characteristics. So if you take the income, for example, the mandate here is to have an above average gross dividend yield than the market. If you take the balance, you go.
Good to see that was supported with recent dividend increases.
Yeah.
That was getting a little bit tough there for a while.
Yeah. I think what's impressive about the situation at the moment is the numbers that you're seeing on the net and the gross side for all these portfolios is 12-month forward looking.
Yeah.
So that's what you would have seen is a larger dividend flow through in that income model over that September period. But the balanced, again, it's a mixture between the two. The growth is clearly, we want capital growth. We want a little bit more risk in this portfolio. We're looking for high return on equity, high earnings growth, potentially some of those other companies that we see as more tactical trades, think around mergers and acquisitions, or themselves going out and investing in another company. And then finally, we have the ethical portfolio. It has only been running for just over a year, but we're really pleased with how everything's going there.
Big push into the ESG space at the moment, isn't it?
It is. It's huge. You see it in almost every single corporate governance statement that came out in September. Everyone's focused on it.
All right. One of the things I like about this is we look at where we're moving forward, but before we do so, we look at what we said last time.
Well, we've got to be honest.
You win some, you lose some.
Yeah, so I think when we're looking back, what went really well for us was looking at that reflationary trade, the reopening of economies, and importantly that infrastructure spend that goes with that. So 2 out of the 3 positions there have done exceptionally well. They've been some of the best performers in the top 50. You think around James Hardie and Aristocrat Leisure. Fantastic.
Does that theme hang around?
Oh, we think so. Now, you've probably jumped the gun on me a little bit because I'll touch on what
Next
we're
slide.
looking forward in the next slide.
All right,
But,
we'll keep going then.
suspense will be killing everyone. With the inflationary environment, what works really well in inflationary environments? So that's that short-term position that we were talking about. Commodities have historically done really, really well in inflationary environments, as have financials. And pleasingly, we've in those last 6 months have been fantastic positions for us.
And obviously reflected in what we've seen in the dividend policy.
Yes.
And capital
Yeah,
management
and capital
programs.
management.
Yeah.
Again, that wealth effect going back to the property, what that does to consumer confidence, retail and consumer discretionary. It was the best reporting season that we've ever seen for consumer discretionary and retailers. Their margins were fantastic, but it comes back to my comment around where consensus was sitting. Everyone was expecting this, and we actually saw a little bit of weakness through that particular sector through the September period. What was working really well was the hedged exposure. Now, by hedged exposure, it means that we're trying to take out currency risk. So if the Australian dollar moves up and you're holding unhedged exposures, it's going to dampen your return against that the currency in which you're holding those assets. Our expectation was that with resources riding exceptionally high, with our economy booming, that you would see an inflow of capital into Australia. And conversely, it's a risk-on currency that we, not conversely, it is a risk-on currency that we operate in Australia. And with global growth at above trend, it should be, all things being equal, our Australian dollar should be rising. It was. What happened since then was we had 2 states locked down for an extended period of time, and it's weakened off. I think importantly though, between that April and now, it stayed around that same period, and nothing is changing in our view on that currency. And then, we still like hybrid positions. Now, hybrids are part of our defensive asset allocation that we utilise for clients. The reason why we really like hybrids is around their floating rate exposure.
One of the things I just might clarify there, when we're referring to hybrids, our main focus is on the your majors,
Yes.
the regulated banks.
Yes, and with that floating rate, it means that once the inflation environment starts to kick off, that all things being equal, that bank bill swap rate that they're priced off, so the floating rate should move up because people will want to be getting a better outcome when they're lending to each other, so banks lending to each other, when you include inflation. So we still like that, and we still think that floating rate exposure is the way to go, because if you're holding fixed rate, and let's take the 10-year government bond rate, if you take a 1.4% 10-year and inflation spikes to 3%, and inflation expectations for a sustained increase spike to 3%, you're now going to be holding a negative returning bond for 10 years. And you're going to see the capital of that bond deteriorate to try and rematch with where interest rate expectations are going.
One of the things that we do notice in these hybrid exposures are the risks around that non-viability capital equity trigger, which is really based off the bank's capital positions. So seeing these earnings upgrades, seeing these capital management programs, it really does underpin.
And the CET1 ratios that we've seen have been the best that I've worked in. And so, you're right. It makes them a more appealing asset to institutional investors. And then finally, we were trimming back on some of our healthcare exposures. Nothing has really changed there. We did a trimming. We still hold our core positions. So if you think around CSL, Cochlear, ResMed, Sonic Health, they're our majors. We've held these for a number of years and continue to back them.
And I'd like to say that we continue to avoid chasing growth at all costs, particularly if we move into a rising bond yield.
That's correct. So what we're focusing on now, I think the reopening and the reflation trade we're still backing. So we've kept those same exposures. Now, new entrants that we've picked up over really the last month, Tyro Payments and Endeavour Group. So Tyro Payments, if you go to a cafe, you got to pay your card, or pay by card. It's the terminal in which that's their main business.
It's almost no other option but to pay by card with COVID.
And we think there's going to be a pent-up demand for people going to pubs and clubs and cafes over the next 3 months as Victoria and New South Wales open up. The other area is Endeavour. Now, 50% of that business everyone will be aware of, which is Dan Murphy's, BWS and anything sort of liquor. The other side of this has been a really tough environment, which is pubs and clubs. It is a spin-off from Woolies, and now with their balance sheet intact and their ability to go out and potentially be a little bit more acquisitive around this area. If you think about their market share, it's only really about 9%. So there's plenty of scope there to grow.
So we're comfortable, particularly around. It's an interesting asset because you've got defensive nature or characteristics of it with the liquor division, but given the environment and what that sector looks like, the growth for acquisition can be appealing as well.
Agreed. And then the next has been running with that theme through reporting season, which is dividends and capital management. I think you can't look past the banks at this point. And then also, which was really surprising, was the insurance sector. So we've taken a position in Suncorp over the past 2 to 3 months. If the weakness in commodities does continue on, and let's say Evergrande does have some significant issues, we'll actually look to increase. But at the moment, we've just kept our core exposures. So BHP and Rio. We've been more actively trimming a position in Fortescue, and then of course we do have our growth position, which is Oz Minerals. Just for anyone out there, Oz Minerals is a copper-focused investment.
So that really ties in with the longer term thematics of the electrification globally, and taking that view with Oz.
Going back to the Australian economy. Really focusing on those, or hopefully a rebound in economic conditions, because we're of the expectation that the next round of data, because it's lagging, will be quite weak. We think that's going to be short-lived. So again, looking at that Tyro, Endeavour and Aristocrat, if you look through how consumers are going, they're actually in really strong shape. And we think that's going to be supportive for companies like Wesfarmers. When you look at how the property market is going, we think that it allows people to be more confident in their purchases. And so we've taken a new position in PEXA. There's other reasons for that. We think that there's a great potential around the New South Wales change in stamp duty, but that's probably more company specific. And then really we think domestically, if you look, there's great fiscal support, great support by the RBA. It really is positive for businesses and the economy in general. So while we think we're moving into a lower returning period, we're not going to have the same year-on-year growth that you've seen in markets and property. It doesn't mean that you can't still be positive within those asset classes. So very comfortable with how things are going. The one caveat, and we did touch on this, is that rising levels of household debt and what that might happen, or what that might mean moving down the track if there does need to be action taken by the regulators. But that's it.
Excellent. Well, I've got you. I might just put you on the spot here. Just one thing, just to close this out, is what's your number one thing in the market that you're watching at the moment from a indicator perspective?
I think our major
can
one,
be positive or concerning.
I think and just to give listeners out there, I'm just one member of an investment committee that we sit on in our North Quay office, and I think the major talking point that we're all watching is wage growth, particularly in the US. What that means is if there's a really big pickup in wage growth, that it's our view that cost push inflation, so the supply shortages and whatnot, that's temporary, but it then becomes a demand pull scenario of inflation. So consumers actually have more money continually to buy more goods or go overseas or whatever the case may be, and that we think is going to be the real driver of inflation expectations, which will be the real driver of interest rates. And so if that interest rate starts to tick up, that's when you will see significant ticks up. That's where you will see ramifications for asset prices.
Yep. So can you flow that through from the US down through to Australia if we see that wages in the US?
Yeah, certainly. So
that flows?
I think the best case that I can think of is when there was a significant rise in bond yields through the mid-90s in the US, and what occurred was it didn't really matter what was happening in the Australian economy. Our bond yields raced higher as well, and it sounds a little weird, but when you think about it, you have the US bond yields, so US bonds, and they in institutional investors' eyes, really anyone's eyes, that's your gold standard of bonds. You're backing the US economy. It's the largest economy in the world. So if you have an interest rate of 3% for the US bond, and then you have an interest rate of let's say 1% for the Australian bond, you'll naturally move your capital from that Australian government bond in chasing of that 3% yield that you can get in the US. And bond yields are inverse to bond prices. So the weight of capital will move, in our opinion, and it has done historically, will move away from government bonds in Australia and move towards the safety and the better yield of the US bonds. So that lifts our bond yields.
And
did that help?
Yeah, lifting bond yields can help in the repricing of high growth assets.
Yes. Well, it's our opinion that will be the major driver of any sort of multiples that you're paying, whether that's property, whether that's ultra high growth. You will see a repricing of assets.
Awesome. All right, mate. We might time that up there because we're definitely out of time. So once again, Mark Alara here, and I'm joined by Kenneth Beanland. Kenneth, appreciate your time.
Thanks very much.
Comments.